Thanks very much. Welcome back, everybody. Can everybody hear us okay?
Yes.
Well, first of all, we have to give an extra round of applause and thanks to Harley, who flew in from New York overnight and was an hour behind and barely, I think, has caught his breath. But we're absolutely delighted to have you with us. Thank you. Bravo, Harley. And Christopher is coming from slightly closer to us, around the corner. I think I'll start with introductions first, and then we'll tackle the questions. Chris is co-founder and chief investment office of the private investment office of J. Stern. It's Jerome Stern, isn't it? Am I right?
Stern family.
Stern family, correct. It's built on the family's 200-year-old banking tradition. And you now manage affairs of other families as well, is that correct? And Harley hails from PIMCO, where he's EVP and portfolio manager in actually the Newport Beach office, is that correct? Yeah. He has a wealth of experience under his belt, having spent 26 years at Merrill Lynch and a few other institutions along the way. Yeah. So once again, I'm blessed with a very experienced professional panel, and I'm absolutely delighted to welcome them to the conference. So our topic in this instance is, can value be found amid momentum-driven markets? So that's the topic we're going to be covering. I think maybe if we start by asking each of you to set out your investment approach. Harley, do you want to say a little bit about?
Sure. Well, thank you.
And maybe a little bit about PIMCO. Everybody knows the name, but maybe they don't know as much as they ought to know.
Well, I spent 26 years at Merrill Lynch. I ran the option business. I ran the mortgage business. I'm here at the start of some private Merrill Lynch. I guess that's a good idea, maybe. Although I was gone before it kind of ended there. Kind of amazing how markets kind of morph over time. And I'm now at PIMCO. I've been here for 8 months. I trade for one of our hedge funds, but I also go and advise the senior portfolio managers about various ideas globally, investment opportunities. You know, what I really enjoy at PIMCO is the unbelievable IQ at this place. It is rather amazing what they know, and the big difference between PIMCO and Wall Street. At least my experience there was the Wall Street firms I was at, everyone always knew their job. They had very vertical experience. At PIMCO, you have the horizontal also. So your mortgage guy would know about Russia, would know about foreign currency. So when you do that, you can kind of see much further about how when something happens here, how it will affect you over there. And it allows you to invest with a longer horizon and see more opportunities. As far as investing in momentum, you know, what I would say, the greatest opportunities in the market right now are being generated by the heavy hand of central banks, as well as the regulation in the financial sector. And it's creating very interesting opportunities out there. And I think that family offices are extraordinarily well suited to find these opportunities. And really, when you're talking about value, momentum, you're talking about risk, there's two kinds of risk. One is the risk, will this investment work or not? The other kind of risk is, if I buy this asset, how volatile will it be on a mark-to-market basis? Right? That's risk. If you're willing to go and absorb that second kind of risk, there are amazing opportunities out there, and we'll talk about some of them in a little bit.
Okay, thanks very much. Christopher, can you set out your wares a little bit for us in terms of your investment approach and a little bit more about Stern?
Yeah, thank you for the opportunity to speak here. We're a private investment firm. As you said, we're building on the 200-year banking tradition of the Stern family. We're based here in London, and we manage the assets of the Stern family, as well as of other families, charities, trusts, and similar investors. The Stern family has a long tradition in investing and has some core convictions, which is to invest in quality and in value. They were part of a banking family that started in Frankfurt alongside the Rothschilds, the Goldschmidts, and other of the great European banking families, and were the family that went to Paris to run a bank there. In the 1940s, they had to escape from the German occupation and went to New York, where they had assets. And they were looking for something to invest in that would be both liquid, but would also generate returns. And so they started investing in stocks. And they had a very good experience with that. And it is something that has stayed with them for the 60+ years since then. So when they went back to Paris to rebuild the bank and get their assets back, they always invested in stocks and built a business to do it both for themselves and for others. When they sold the bank in 1988 to what is now UBS, they kept the investment team and continued to invest in stocks in the US, in Europe, and increasingly also in other markets based on the same investment approach. And we are the continuation of this family effort and have set it up here in London, doing it both for the family and for others. We have a very strong conviction that stocks are assets, and that to invest for the long term, to try to preserve wealth and to increase it over time, is a question of trying to generate returns of 8 to 10%. That's the track record that we have in the family from having made these investments over time. We have our own analysts, we believe in doing our own research, and in holding assets for the long term. So for us, risk is being able to preserve and increase that wealth, and it is, in this environment, really not being invested. So for us, risk is not, as Harvey was pointing to, is not volatility, it's not drawdowns, it's not even relative performance, because we are looking for absolute performance based on the fundamental value of the assets that we're invested in. So I think that goes to the heart of the question that we're trying to ask here. And we certainly have a very strong conviction that investing in value and doing so over a long period of time yields the kind of results that we're looking to achieve for our family, but also for the other families that we manage assets for.
Well, you started to answer the second question that I was going to pose, which was, do you seek to capture value by taking advantage of existing trends? So I know you're very much fundamentally based in terms of your approach, but what are you doing in this world of the world we live in today? I mean, it's a pretty confusing place with the quantitative easing just beginning to come into play in China. They've moved their rates down for the second time in the last week, from 3 months before. You've got the quantitative easing, which is in Europe taking place, which is way behind the curve of what the Americans did. So speak to me a little bit in the current context. How do you capture value by taking advantage of existing dislocations in markets?
You know, when you look at markets, you look at the world, you can look at an ocean and you can see the ripples on top, and people will comment upon that. So maybe they talk about the trend as being the ripple on the top going one way. What's vastly more important is to identify the real trend, which is the underlying current beneath, the big riptide that's pulling. The big riptides that are pulling right now, clearly demographics is a major driver, and being able to appreciate how that might work, the baby boom generation in Western Europe and the US as it ages, and the demand for equity or for debt. And the other big trend right now is government regulation. Glass-Steagall came down in the US, Dodd-Frank is way of putting it back in, and this is a trend that's not going to be ending soon. This drives people to go and look for short-term investments when there is value in longer-term investing. What would be an example? If you look at Japan, they have a very interesting dynamic where 35 years ago, you had only 18 retirees per 100 workers. 5 years, which was the best in the G20, best in the civilized investing world. 5 years from now, it'll be 48 retirees per every 100 workers, which is by far the worst, much worse than the US or anyone else. This kind of thing drives the currency and the markets there. And so where some people might go, I'll leave out names, buy 1 and 2 year options or investments. If you look at longer term, a little less liquid, but 10-year options, you were able to go and buy a 10-year option, simple, generic, white bread vanilla option, dollar yen. This was just 8 months ago. It was my first trade at PIMCO. the yen was at 102, you could buy a 100 strike option, dollar call yen put, for 6 points. Now that's kind of interesting, right? Once you lose a 6, you can make unlimited or 2 points in the money. But what was more interesting is that an 8-year option cost 6.5 points, which basically meant that you're paid to own an option. You have this nice upside horseshoe, right? As opposed to the downside of short optionality, complexity. It faces like this. You're paid to own an option on what you think to be is a macro trend that's going to take it. So when you buy a 10-year option, there's some bid offer, and it's wiggly, man, okay? It's not a straight line. If you're willing to absorb that kind of risk, which is wholly reasonable and suited for people of your ilk, you can do quite well. And clearly, yen now at 120, it's kind of worked.
Chris?
But we see a lot of value out there. I think we're clearly in a world where, because of the quantitative easing and because of the extraordinary measures that central banks have had to take to offset the impact of the global financial crisis, we've seen a very clear erosion in yield. And so it is very difficult to go looking for yield, and if we look for fixed income investments, as set out, we're looking for quality and value. To the extent we need to go down the quality curve in order to find any kind of acceptable yield makes it very uninteresting. But if you look at great global companies that have the competitive advantage in order to succeed at what they're doing, that either make something or provide a service that people need, then we see great opportunities. You see stocks that having dividend yields of 2 to 3 to 4 or 5%, which provide an income for those people who need it, but show the relative value that you have from investing in those kinds of assets, but they also have growth. And so we have a very high conviction looking at what is going on, especially in the United States, but also globally, that we are turning the corner after an 8-year period really of malaise, that the quantitative easing that has taken place in the United States has worked, that we are getting to a turning point in terms of employment, in terms of income, that is going to drive consumption, is going to drive the capital investment that you need, and that the United States has pent up over at least over the last 8 years, if not longer. So if you look at companies, for example, that are in our core portfolios, stocks like, for example, United Technologies or Rockwell, some of the great American capital goods companies that do business in that kind of environment. Or if you look at companies that do business globally, then we think that these are very compelling opportunities today to buy them at valuations that we think are compelling in absolute terms, that are compatible with making the 8 to 10% target returns that we're looking for, but that are also generating yields that are, in terms of the quality of that yield, superior to what we see from fixed income investments.
How concerned are you with short-term volatility?
You know, I spent 30 years on Wall Street, and you learn a lot by being involved in the sausage making process. And I kind of could have gone anywhere. I have 4 kids. My last one went to college a few months ago, so I'm kind of free. Well, that's why I go to Newport Beach and get a suntan. It was 12 degrees in New York, and I was in my convertible with the top down last week, so I can't cry about that. And I will say that the commute from Newport Beach to London is a little challenging. But the beauty of PIMCO, I guess I'll give the paid shill, plug over here. Why am I at PIMCO is you have this vast, you need a certain scale to do anything efficiently. And one thing you need is scale of IQ, scale of intelligence. If you go work at some small investment firm, some boutique, you're kind of by yourself, you're kind of on your own to figure things out. When you're at a large investment firm, PIMCO offers all the products out there. You can go and talk to that person, all of a sudden, you can piece together ideas. And that creates rather interesting opportunities right now. And that's why I really enjoy where I am, aside from the weather, is the ability to go and lever intelligence to find opportunities out there. As far as mark-to-market, once again, we got, $1.6, $1.7 trillion. We can go and absorb a little more volatility than others, and therefore it gives us a little more leash to go and take advantage of opportunities. And also, we can source out interesting opportunities as okay, Christopher over here. There is a value to be around for a while. There is a value of old age aside from being a little bald, a little fat.
Christopher, do you want to say anything about short-term volatility and?
Well, I think it's inherent in the different approaches that the investors have and that different family offices have to how they invest their money. If there is a concern around volatility because people have strong views about that in terms of the risk that it implies, if there's a view of running portfolios on a levered basis, which we don't, where drawdowns and margin calls are of great relevance, and if there's a concern about performance, in other words, if there are families who do benchmark their performance on shorter-term measures, whether that's
prudent or not,
yearly or then there clearly has to be concern around volatility because there are cutoff times and there's averages that have to be achieved. But if you can take a truly long-term approach, and both us and the families that we manage money for have that kind of approach and say we're looking at things on a generational view, we're looking at performance on a 5-year basis, then that is long enough to absorb most cycles. And so we are really not concerned with volatility at all. We see it as an opportunity. And if we even just look at the last couple of months, years and months in terms of the performance, they have been opportunities. And I think I'll highlight just a very obvious one, for example, Nestle in some of these Swiss stocks with the shock devaluation of revaluation of the Swiss franc after the unpegging. It took a grand total of 4 weeks for the stock to essentially come back in Swiss franc terms. So if you're a euro or a dollar-based investor, you benefited from the Swiss franc because the stock was actually up in those currencies on the day. It was down almost 12% in Swiss francs because of the translation effect.
Because of the translation, yeah.
4 weeks, you've basically made it back from investments in a great global company. So if you talk about risks, that's volatility. It's a horrific experience if you're, I think, involved in hedge fund money management. That's a very substantial thing you have to deal with. Hopefully you were hedged, otherwise your month looked terrible. If you reacted to it, you made a dreadful mistake, whether you're an investment manager or a family that's adjusting what they do. And so the idea of saying I'm going to stick with it, and actually a company like that and that has operations all over the world, that has cost aligned, offers you, you're not even worried about, you don't even have to worry about currency volatility, let alone market volatility in terms of what you're doing. So,
I would have one more thing over here. The mantra, obviously, we all know, investing 101, diversification is always very important, but a close second to that is sizing. Sizing your investment is more important than entry level. Because if you don't size it properly, you can't survive from here to there to go and make your reward. There's plenty of people who've made investments where they've been right, but they've been stopped out of the trade because they were too large or too whatever. If you have the right size of the trade, then you can, with the right vision, make it from here to there to your view. Obviously, buying low is better, but nonetheless, realizing the terminal value is more important.
Okay, here's a bit of a curveball for you. How do increasing regulatory constraints fit into this whole picture? I'm looking at it from not only your side of the table, but also from the diversification of your client base and the fact that the regulatory environment is changing rapidly for investors. There are going to be increased reporting requirements. I think that's going to color a lot of approaches. I don't know. Do you have any views on that?
Well, we're concerned with it both for ourselves, for our clients. The core of what we do and we offer is the investment management, but we also run a private office both for ourselves and for others where we're obviously very concerned about those developments. And the increasing need for compliance in the different jurisdictions is completely obvious. And I think that for us, the simpler we can structure the investments and the more directly we can hold them, the more attractive they are to us. And so what we do is we don't manage funds, we manage managed accounts, separate accounts that people have, family members, entities, or other investors at institutions that that they have relationships with. And it's very important for us that we be able to have complete transparency about those arrangements. But in the same way, we can also offer complete transparency over the investments. So it's one of the experiences that I think comes from the family history, having gone through such a long period of time and having lost effectively all the assets, with the exception of liquid assets that were in the US in the 1940s as a result of the dislocation. There's a very strong view that having simple assets that are liquid, that are held in different places in the world, but in very simple structures, is actually a way to avoid those issues. And the more I think you're able to do that, the less exposed you are necessarily to some of these changes, and frankly, the more prepared.
PIMCO, because of our scale, we have the ability to be totally covered with what's happening in regulation and offer transparency to our clients. But what's interesting now is government regulation is almost a value investing opportunity because investment banks are being challenged from many different angles as we basically reinstitute Glass-Steagall. And the way the regulations are presented to investment banks are sometimes very linear. You have to cover this specific risk over here, but it doesn't really detail things surrounding it. So we are presented with opportunities to make investments that are kind of capture the other side of this. And really, I won't say it's free money, but it's highly probable money because you're really insuring against, you're offering an insurance policy against very unlikely events. And it's not selling tail options. It's not selling options on the wings. We don't do that at all. We usually tend to be long those. You're involved in correlation things like that banks can't hedge. So in that sense, regulation actually is very good for PIMCO and very good for most longer-term investors because we do have the capital and the deep pockets. We, all of us here, to go and step into the shoes of what the banks used to do.
That's a very good point. We only have a couple of minutes, and I really would like to open up for questions. This is a great opportunity to engage with two great firms, seasoned investors, yes. And could you tell us who you are? Yeah, where you get a microphone? I think I know who you are, but just in case.
Hi, Ian Fidel at Grosvenor Estate. I just wanted to ask Harley about the pricing of these ultra-long-dated options, because that does seem sort of bizarre, the way you describe the pricing on them. Is it because the market is very thin and very imperfect at that end? And is the downside there's just very little liquidity if you want to offload your options afterwards? Because if I'm looking at shorter dated options, the price of a 12-month option is always going to be far more expensive than the price of a 6-month option. Well, so here what you had to say about an 8 or a 10-year option is pretty surprising.
I will tell you this.
By the way, the second question, is that 12 centigrade or 12 Fahrenheit?
What was the second question?
12 centigrade or 12 Fahrenheit?
They're both rough. I will say, I like to look for free options. I like to find things that look like this, and they are out there. Most of the things I deal with, I'm a 30-year derivatives guy, okay? So that makes me a little scary to some degree. But most of what I'm involved in is extraordinarily white bread. They're on the exchange, they're vanilla, they're just not, a 1-month option, which we're all familiar with. If you want to see a little bit more, you go to the PIMCO website and look under the viewpoint, what I've written about, and I describe some of these ideas, but specifically why, I don't want to be too geeky over here, there's a very strong correlation between the yield curve and volatility, and what happened in a nutshell was they went the wrong way. They should have gone like this, and they went like that, and that's what created the opportunity. And these options, we're not talking crazy bid offers, but maybe I'm going to pay, 15 basis points to get in as opposed to 2. Is that, that's a big bid offer, I guess, to go and pay. But if I'm buying an option that's going to carry positively, and I actually believe in the macro bet, what's wrong with that? This kind of begs the question. People get hung up on bid offers sometimes. If you think an asset is worth 12, and you know it's worth 12, and one guy will make you a market 11.50, 11.60, another guy will make you a market 10.11. Who do you go to? Okay, think about that. There are a lot of people out there who prefer that guy who makes it, 50, 60 because they're tired of it off. But you'd rather buy from the wide guy at 11 and make a bigger profit.
Chris, do you want to add anything to it? Let's have another question. Did the 30-year derivatives, did that frighten everybody?
I'll answer another question that you're thinking about. As far as big thoughts to think about, sometimes, and this is for both of us, don't get hung up on the front page, the ticker of what's going on. Try to take a step back and look at the big thought, the big flow, the big idea. The big idea with the Fed as far as raising rates is what is important to Janet Yellen. We read the Greek tragedies 2,500 years later because humankind has not changed. It's never different this time. Greed, ego, hubris. Janet Yellen following Bernanke. What's Bernanke? Bernanke was the king, the expert on the Depression. There was no Great Depression. It was back-to-back recessions, right? In 1936, we were fully out of it with inflation and growth, and we came right back in because of bad Fed policy, right? They raised taxes and hiked rates. You will not see this Fed raise rates too early and risk us going down again because they will not take the ego damage, forget the money, the ego damage having caused a repeat of the Great Depression. And I think if you look to people who operate under ego, that tends to be the great downfall of mankind, and that hasn't changed in 3,000 years.
I think it's quite interesting because Christopher started talking about the history of the Stern family, which, given all of the upheavals that the family went through, I think the behaviors and the human experiences really inform the investment approach that you have. I mean, just as you said a little bit earlier, we like to keep it simple, we like to keep it direct, we like to keep it transparent, and we're looking to build long-term value. And I think the two really fit together quite nicely, because I do agree with Harley. If you don't start by addressing the human behaviors first, I mean, I think you run a number of risks. Because let's just think of all the financial crises we've seen. How did they arise? I can remember I was in Frankfurt when do you remember the rogue trader, the Lehman, the Barings guy?
So many of them.
So no, but the classic
Yes.
one, the early one, the one who was in Hong Kong.
Yes.
Yeah, Singapore. I was on an exercise machine in Frankfurt when that news hit, and I turned to the person on the exercise next to me and I said, lack of controls, lack of internal controls. It took, 6 months for that to come out? Lack of internal controls. I think that's just,
Then the firm was saving money by not having someone
Yeah, right, saving money. Would anybody else like to weigh in here? We only have a minute or two, I think. We're about to be called time. Michael.
Following on what Harley was saying, do you really trust the central bankers? Do you actually feel they know what they're doing? Yes, you say they don't want to plunge the world back into whatever, but there are other things going on. Look at the geopolitical problems there are throughout the world. The Middle East is so much worse than it was when I was growing up in the 1950s. You look at the situation throughout Europe with Greece. You look at the situation with Vladimir Putin. I think there are other external things which may force Janet Yellen and the other central bankers to do things which you may not think they will do, but they may have to. Do you trust them?
That was two different questions. I'll answer both. One is trust, the other is bad things happening to different places. As far as the second part, I don't think human history has changed one lick as far as bad guys doing bad things. It happened in the past and will keep on happening. So Francis Fukuyama was a little bit off on the end of history there. As far as the first part goes, what does trust mean? I trust that she will act in a way that's most beneficial to her ends. And
the best interest of America or the best interest of the world?
America first.
I would assume America. I would be more micro than that, and be more local about herself. I think that once again, if you take a step back, all the points you made are all valid, they're all reasonable, and I agree. And I do think that these various issues going on globally, she will be thinking about them because they'll affect the currency markets, which affects inflation, which is the key driver for her. But in the same way that the guy in Utah, in the story, he went bicycling, fell in a pit, and had to cut his arm off with a penknife. He didn't wake up that day and say, "What a great day to chop my arm off." He fell to a pit and said, "I got to do this because Plan B is worse. Like I'm dead." The Fed. I mean, there are people who think Bernanke did a good job or a bad job, and Jim Grant thinks we should have done nothing at all. Whatever. From my point of view, Plan B was worse if the Fed had done nothing. The government had done nothing. Did we save some of the evil bankers who should have been punished? You betcha, man. But it's just the cost of doing business sometimes, and I kind of trust that Bernanke and Yellen are acting in a reasonable fashion that will get a reasonable result. Is it optimal or the best result? I don't know, but I do feel good that I trust them more than most politicians.
Have they got a plan C? You talk about plan A, plan B. What about plan C, plan D, plan E? I think for all families, I tell them, you don't rely on plan A or plan B. They may all go down the tube. You've got 26 letters of the alphabet.
On that happy note, thank you very much, gentlemen.